Kamau, karibu sana.
Good evening, ladies and gentlemen. Welcome to Creditinfo's second edition of the Fireside Chat. Something we started this year. Ideally, the idea is to be able to get industry people to come in together, sit together and discuss topical issues, discuss, deliberate, and get insights from each other, learn from each other and see how we can develop and make things better on whatever topic we are talking about. So I'd like to thank all of you for taking the time to actually come by today for this second edition. This time round we're talking about risk-based pricing, using scores for risk-based pricing, and I think it's quite topical, especially right now in the current environment that we're in. A lot has been happening. The recent budget announcement of the bill passing that to lift interest caps, how is that going to change? Are we going to start seeing, are we going to go back to a regime of expensive loans? Are we going to see a more open or more differentiated pricing for consumers based on their risk? We had earlier on the central bank charter on using scores for determining an individual's risk. How is that going to be implemented? And of course, the biggest thing that everyone has been talking about has been the growth and penetration of the mobile lending and how that is affecting traditional loans. Is it a good or bad thing? Are we over-indebting our young people to do, immoral things like, I don't know if it's immoral, but they say it is, like gambling and so on and so forth. So I mean, there are quite a number of things that all revolve around how individuals are being scored, how they're being selected for various products. So I think this is a very good topic, and I expect that it will be very engaging tonight with a lot of comments being thrown at the panelists. So in regard to the panel, we tried to give a mix to try and balance out everything. So we've got a banker who is on the risk side, we've got a banker who is on operational side, and we've got another banker who is on, I would guess, on the product side. And I guess all those three areas, in one way or the other, in any given environment in a bank, you'd find them fighting for some sort of turf or or respect, or their voice needs to be heard because they all have a voice to say. So how do those different parts play in actually implementing risk-based pricing going forward? Is it going to be an impact that's going to be negative or positive? And we see how that goes. So I think it'll be quite interesting to see how it comes out. But before we start, I have to sell. I have to pay for the session. So I just want to, so I'll try not to sell actually. I think what I want to do is kind of like set the stage for the discussion today to try and get the tempo going. So the sales bit. At Creditinfo, we periodically release reports on different movements in the market, what we see in the market. So we try and get some data, based on the data we receive, reports to give the market insights on what is happening. These insights would be ideal to actually help clients identify niche customers, niche areas or demographics that they could actually be able to attack or be able to approach in terms of a growth plan for their business. So the report it's a benchmark report. We also use it to help our clients benchmark their products, their services against the market. So bank A's, credit card, how are you benchmarking against the credit cards in the market? So it's quite a bit of insight that is derived from actual data reported to the Bureau. So again, as the data or the report that I show or whatever I present is based on what is actually reported by the lenders into the Bureau. So I think just to take you through this and not to take too much time so that we can get to the more interesting part of the evening, this is basically a quick analysis on traditional loans. And the way we've defined a traditional loan is a loan that's over 50,000 and a repayment period of at least 12 months. So that is not your micro loan. So this is a traditional loan, your mortgage, credit card, and so on and so forth. And we've defined default as an account that has gone 90 days past due within a 12-month period. So remember that. So we are looking at 90 days past due in that 12-month period, and it's only loans that are 50,000 and above that you're looking at. I think you can go now. So when, you can go again, it's the same thing. So when we looked at that, we said, okay, fine, let's look at what the environment looked like in 2018 for traditional loans based on the definition that I gave you. So there's total number of loans. It's actually a bit shocking. 500 or just under 600,000 loans in 1 year by 56 subscribers. Now those 56 subscribers would be your commercial banks and deposit-taking microfinance would constitute that, those 56, within the year of 2018. Now, 600,000 sounds very low to 475,000 borrowers. So I think that is very telling that there's been a lot of influence or shift from your traditional lending to lending off on a mobile phone for lower credit and not taking the bigger amounts for a longer term. So there seems to be a shift towards short, small credit. But that could be one argument. The second argument could be the banks just didn't lend. There was a cap. I don't know. But that's what the data says. So average number of loans per individual, 1.2, and only 22,000 companies. That was also another very worrying statistic. Now, what do we refer to here as a company? A company is a non-individual. So any loan that was reported into the Bureau using a company registration number. There's arguments that you could have SMEs that are within the 452,000 individuals who have borrowed as an individual to inject the money into their business. But we don't have view of that, so we don't know. But we can see the companies actually registered for a loan or applied for a loan as a company were only 22,000. And the makeup to those numbers across the months are there. I don't know, maybe the bankers will explain to us there could be a reason why there was a peak in November. But that could be informed by anything. It could have been a particular bank maybe that was having a promotion. It could be anything, any one of those things. So that's what that's what it looked like in 2018. So then I thought, okay, fine, if that's what it looked like in 2018, maybe it would be a good idea to try and understand what does it look like from 2016 when the interest cap came in. Has there been a lot of shifts? Was 2018 the best year? Was it the worst year? How did that actually move? So when we see number of loans from 2016 has progressively been decreasing. Again, these are actual loans that were applied and opened for within that specific year. So I'm not giving cumulative numbers. These are actual loans that were applied for and issued within that particular year. So over time, in general, we are seeing a decline being reported, and also in terms of the amounts. The number of lenders, it keeps shifting up and down. We've had additions of, from 2016 to 17 of deposit taking microfinance. From 17 coming to 18, you have had your Chase Bank, Imperial. You've had a few bank mergers, so they actually collapsed into one bank. So you see that shift moving in. This here is what is also a bit strange. But I think it's kind of telling from what we also see, what is published by the commercial banks when they're doing their annual accounts. Most of them have actually shifted into T-bills, and they actually announce it, and they actually show that there's actually that big shift of money being put into treasury bills. So from this, it's quite obvious what was happening. There was more focus in maintaining existing portfolios as opposed to growing the portfolios into new loans. So year in, year out, they've actually tried to keep that fairly stable, put more money into more secure investments like your treasury bills, and then maintain the current portfolios that they have and just grow it by a bit. So I think it's very selective lending to people that they know to minimize that risk, and I would assume that was informed by the interest cap that is there. So this looks at, what does this look like? Oh, the average loan size given by the different lenders. So your banks, as expected, average loan is about 3.1 million. So again, for 3.1 million average loan size being given to the banks, you're looking at people, the high affordability bit of the triangle that are actually getting the loans. And your MFIs are dealing with the guys who, in terms of capital, the lower side of things. So it's again very distinct who is targeting who, or where consumers actually go for their facilities. So your high net worth will tend to go to a bank, obviously, as we know, and your low net worth are going to the MFI. And it's quite reflective in what we're seeing that's being reported. So it starts getting more interesting when we start seeing the average loan size within the banks across the different. So the slide we saw before has combined within the banks your consumer and your business. But when you're going deeper to the bank and see who are you giving these loans to, your average loan size to a business was coming out to about 23 million, and to the consumer, about 700,000. So again, these are big businesses that are getting loans. Those are the people that are feeling comfortable to continue give facilities during this interest cap period. The individuals that are giving the loans, that's fine, but then not that high much. The limits are not that high. The limits are actually being driven by the companies, as you see there. So we thought, okay, fine, let's try and break down that further to understand the different, so we identified brackets between 50,000 to 100,000, all the way to above $1 million. What percentage of the total portfolio being lent by banks, and where are these people sitting? Again, the high net worth seem to be getting the bigger chunk of the facilities. These are people, again, that they know, they understand, and have or feel secure with them. So you start seeing a lot of high-ticket loans are being given, at least the majority of the portfolio are either high-ticket loans or low-end amounts. But consistently over the years, from 2016 to 2017, this segment over here seems to be the lower end. I don't know why it's not there, but I think the panel will be able to inform as to why that could be the case. But that's what we're seeing in terms of the amounts being lent out to in the market between 2016 and 2018. So going to today's topic, we thought, let's understand. So we understand that it seems like they're giving more high net worth guys the money, and they're getting the higher balances. The businesses are the people getting the high amounts. But let's try and understand, what did these guys look like from a risk perspective? So we went back to 2016 and we thought, let's look at all the loans that were issued in 2016. And remember this, these are only loans that were issued in 2016. And we said, let's score them. And we found, and we said, A is your lowest risk, E is your highest risk customer. And then we mapped that to actually look within 2018, how many of those individuals at any particular time did they go 90 days past due within that 12-month period? And that is a black line. So it shows the score is actually quite predictive because the A guys are the guys we said are the least riskiest, and the lower number of them actually defaulted or actually went 90 days past due within that 12-month period. And the highest risk guys, the E, a higher percentage of them actually went into default within that 12-month period. So this is between January and December 2018, or 12 months from the time they took the loan, basically, within that 12-month period, but for the loans that were applied for within 2016. So it's very clear that the lenders are selecting their customers. You can see they've got a good number of low-risk customers who are being given facilities. So the selection of or identifying a good customer is actually very good, and it's well demonstrated there, and the score is quite predictable in actually determining that. But it becomes very interesting when you see what were the amounts that were lent to those individuals. The guys with the least risk were given the lowest amount. The guys with the highest risk got the highest value of loans. I don't know why, which doesn't make sense. But that's what was reported. So we said, okay, fine. Maybe there was something wrong in 2016. Let's look at 2017. And 2017, again, the same thing. So the highest risk guys were getting the highest value. Why was the case? So I don't know. Maybe they'll tell us. I don't know if so I started thinking, so does it mean, we were asked about the 5 C's. They're getting the highest risk guys are the rich guys because of the guys with the capacity. So it could be bad, but your capacity says you can get a bigger loan. Could that be the case? Or could it be a case that they're willing to give the guy because the guy is giving a big collateral? I don't know. Those are things to look at and discuss. Sorry? Maybe. They could hire the best lawyers.
Yes.
Maybe. But it's quite interesting. And then we go to...
Or maybe they're politicians.
Yeah. 2018. So in 2018, we thought maybe it will change. Allah, it never changed. It was the same thing again. The highest risk customers were getting the highest limits. On 2018, I've got to say that this is only data of loans taken between January and May of 2018, because those are the only loans that we have a 12-month view to determine the default, which we said a default is any loan that has gone 90 days past due within a 12-month period. So any loan from June going forward is not here. So these are only loans between January to May where we have a full 12-month view. But again, higher limits to the highest risk guys. So I think it'll be a good discussion to have the panelists up here be able to give us an idea of why that case could be, and then if in actual fact the score can actually predict well based on actual results that we are seeing and when they were scored, is it an opportunity to actually use those scores to be able to determine what balances or what loan amounts you can give your consumers? So I think that would be a good point to begin the discussion. So I'll invite Ali back up here and the panel, call out the panelists. But please engage, and I hope we can have an insightful discussion. Thank you.
Thank you, Kamau. That was quite insightful. So as we are doing that, Kamau, thank you very much. Maybe there is a burning question before we start our panel from Kamau's presentation. I mean, I have a few, but I'm known to be politically incorrect, so let me maybe not bring that up here. I'll probably wait for the panel. Anyone with a burning question, clarification for Kamau before I introduce my panelists? No? Okay, great. So it gives me great pleasure to announce my panelists, and as I call their names, please come up and take your seat. Let's start with Nancy Kinyanjui. Nancy is, where's Nancy? Nancy, Karibu. Nancy is head of products and analytics at Creditinfo Kenya. She's got product management experience. She's worked across from Safaricom, Barclays, and she's a data scientist, right, Nancy? Nancy, Karibu. Next is Catherine Muraga. Catherine is Director IT Operations, Sidian Bank. Catherine, Karibu. Next on my list is Alex Siboe. Alex is Acting Head Digital Financial Services, KCB Bank Group. Alex, 16 years experience in the banking and telco sector. You know, I get confused these days. I don't know whether you are a banker, a telco guy. Yeah? Alex, Karibu. Next is Chrispus Muhia. Chrispus is head of consumer credit at Barclays Bank. Timiza, right? Great. So I am going to now take my seat and start having our conversations. So guys, what's this thing called, it's a bit of a mouthful, scoring for risk-based pricing. And let me start by sort of giving a bit of a background on what this is all about for those of you who may not be bankers. And then we'll sort of have a conversation around that. Risk-based pricing in the credit market refers to the offering of different interest rates and loan terms to different consumers based on their credit worthiness. So I'm going to stop there for a minute and let you guys sink that in. You're supposed to be offered interest rates or size of loan according to your credit worthiness. The question is, does that actually happen? And I'm going to let that sort of lie there for a minute. So risk-based pricing looks at factors such as a consumer's credit score, adverse credit history, if any, employment status and income. It does not consider factors such as race, color, national origin, religion, gender, marital status, or age, which is not allowed based on the equal opportunity credit opportunity that is in the US. And I would suppose this would be something that's close to what we should be expecting in our country. So, to our earlier conversation with Michael on the social credit, and this conversation around risk-based pricing, I'm going to ask Michael to sort of kick off, Chrispus, to sort of kick off with opening statements. Maybe, Michael, you should have been up here. Chrispus, just a bit of background from your experience from working at Barclays, and maybe even before Barclays, if you've worked before. Just give us a quick outline on what you feel this is and whether this is something that is good for the market. This is obviously something that the central bank governor has actually also talked about. To what extent are banks actually executing this? And then we'll go around with my panelists. I'll ask you guys a few questions and then...
Thank you, Ali, and the audience for inviting me to this very topical discussion on scoring for risk-based pricing. And I think just by way of introduction, my name is Chrispus Muhia. I'm the head of consumer credit at Barclays Bank. And
I think guys can hear you, Chrispus. Is there a problem with the mic? Is it on?
Apologies for that. Can you hear me now? Am I audible? Thank you. I shout a bit more? Good. So thanks, Ali, and the audience for inviting me to this very topical discussion on scoring for risk-based pricing. And but just by way of introduction, as I was saying, my name is Chrispus Muhia. I'm the head of consumer credit at Barclays Bank. I'm a member of the ABSA group and soon to be ABSA Kenya Limited very soon. So we're in a rebranding exercise. And I think a good place to start on your question, Ali, is first of all to just give a bit of background on my institute, on the organization I work with. Barclays has been in this market for quite a long time, 103 years, and as a part of a respected financial group and a mature bank, has had its credit methodologies developed to quite a good extent. And scoring and risk-based pricing are actually core elements in our approach of how we do business, how we contribute to the credit market in this market. So now, Ali, you've mentioned the recent developments. You've mentioned what the central bank is doing and so on. And really, I just want to bring in context. So I think as a country, we come in from an operating space where there has been issues around perceived high cost of credit. And if you go back a couple of years, you'll see that consistently there have been a couple of interventions that different bodies, including the regulator, the central bank, has tried to bring in. So if you look at a couple of years back, there was efforts around introducing the KBRR rate, and later on there was the CBR rate. There have been efforts in 2014 specifically by central bank and also by the Association of Bankers, the KBA, to bring in what was called the total cost of credit. And more recently then, we've seen efforts from a legislative perspective. We have, our good MPs have taken matters into their hand and brought in the rate cap in 2016, as we know it. And the effort has not really stopped there because, as Ali mentioned, from March 1, 2019, Central Bank also legislated what we're calling the banking charter. Also Steve Kamau did make an allusion to the banking charter. And when you look at the whole essence of the banking charter, it just comes down to 4 items. And one of the key pillars, one of the 4 pillars really is what is risk-based pricing, and scoring also as one of the tools. And I'm sure we'll discuss more about that. So I think in a nutshell what I'm saying is that there have been efforts to try and deal with the perceived high cost of credit. Those efforts, the different ways of dealing with it. We've seen efforts from legislative attempts. We've seen efforts from policy perspective in terms of the KBRR and the CBR. And all these have pros and cons. I think the biggest really impact that we've seen with the coming in of the rate caps was private credit moving from upwards of 20% to about 5% currently, and that was very evident in what Steve was putting up in the bar charts that are there. So it's a topical conversation, and I'm hoping as we carry on in this evening, we'll be able to see how these two concepts of scoring and risk-based pricing come together, and how they support each other to give outputs or outcomes for customers.
Chrispus, thank you very much. Alex, over to you. Alex, maybe as you talk about this, give us from a perspective of what what the VUMA division of KCB is doing. I think, from my understanding, and you can correct me if I'm wrong, you guys have a sort of a revolving mobile lending loan book of about 32 billion shillings today. How have you driven that sort of level of growth, and where is scoring and risk-based pricing coming into play here?
Thanks, Ali. As Ali has mentioned, my name is Alex Siboe. I work for KCB, Digital Financial Services, aka VUMA. I think I'll just give some background. I'll pick out from, I think, where Kamau was trying to show us in terms of the different profile of the market space. I think from my own perspective, before I speak about VUMA, is prior to 2016, the industry by itself had sort of differentiated pricing across different segments of the market. You could see different pricing for personal, SME, micro, corporate, banking. And basically, it was put in those buckets because of the risk profile of the different segments of them, or the perceived risk profile of the different segments of the market. And I think that time, because there was no legislation or control around pricing, there was a bit of legroom to be able to differentiate and price accordingly, according to the risk. Then 2016, Parliament was happy, introduced the cap. What it did is that the legroom was reduced. So more or less across the different segments of the market, pricing is a bit of a differential, of course, across the different segments, but it's more or less standard. Virtually, you walk to any bank, pricing is no longer a competitive edge. Because I remember before there used to be headlines. KCB, 16% or whatever it is, 17%. And it was a catchy phrase where you could attract all the customers into the market, into the branching, into our banking hall to be able to access credit. I think one industry that sort of interests me and has been, of course, there's been no evolution, is SACCOs. They have kept their magic 1%. And yes, since I was born, and I think for the foreseeable future, I don't see that changing per se.
1% what?
The pricing for their loan facility. 1%.
Interest?
Yes, it's 1% per month.
1% per month?
Yes, so 12 per annum.
So that's 12% per annum?
Yes. I think across all SACCOs, that is the price point, so to speak. So now, when you look at what is happening in the market, and this is from around 2012, when Safaricom partnered with CBA, and of course, we also, from a KCB perspective, we have a facility for our own customers. There was a new invention that came into the market, whereby now, without knowing any customer, you'll be able to offer a facility. Of course, thanks to the mobile telephony.
What do you mean without knowing a customer?
Okay, banking, you ask a very important question. Banking is driven by one key acronym, KYC. And by definition, you're expected to come to the branch, take photos, fill forms. You have a guy there checking and confirming, for sure this is Ali and this is his ID. Now, using technology, we're able to opt you in. We're able to score you, and you can be able to access credit on the fly. As you speak now, and that is thanks to technology and thanks to the partnership we have with Safaricom. I think the telco industry has revolutionized that market, so to speak. Because prior to that, there was no information that you could use to be able to score or evaluate a customer. But thanks to that now, with the use of telecommunication data and M-Pesa data, you are able to hedge your risk and be able to price and be able to offer a facility to a customer. As you mentioned, as we speak on a monthly basis, we process between 2 to 3 million loans. I think he was mentioning about 500,000 in a year. When it comes to the micro lending space, you can do 2 to 3 million in a month, over 100K per day, so to speak. Of course, the ticket size is a bit small, about $50 or 5,000 shillings per ticket. And we are able to disburse over 10 billion every month, so to speak. And from a pricing perspective, of course, It's priced based on tenure. It's limited, 30 days. The expectation is it per se is to take you care of you on a rainy day. Micro lending for emergencies.
Alex, thank you so much. I'll come back to you guys on some burning questions that I have and a discussion. So I'm going to now go to my sisters here. And in fact, just as I was listening to Chrispus and Alex, I wondered why we've sort of demarcated female and male. I was almost about to tell, can we just mix it up a bit? But it's okay. It's a panel. Catherine, from your perspective as a technical lead in a bank, and specifically a bank like Sidian, that sort of has evolved from KREP that used to serve groups mostly and small micro enterprises to today. In your day-to-day role, how do you assist the business leaders to ensure that the bank is making the right decisions when it comes to scoring for risk-based pricing?
Thanks, Ali, and glad it's not a panel. There are ladies at least in the panel. By way of introduction, as mentioned, I'm Catherine Muraga, CIO at Sidian Bank. Sidian Bank is a subsidiary of Centum Group, not as big as Barclays and KCB, 25 billion balance sheet. Interesting topic. We've not ventured into the sort of stuff KCB and Barclays have gone to, still on traditional type of lending, referencing a lot data from the credit reference bureaus. So our pricing is mainly bottom line, what makes sense for the business. In terms of your question, a lot of data analysis, but I also see there's a lot of opportunity to partner with credit reference bureaus in terms of now moving more towards what the other players have done. And it's a space that Sidian is also considering moving into by way of mobile lending. And also, current focus being SME, as you rightly mentioned. Previously, KREP focused a lot on groups and individuals in the groups. Now moving more, which was also risky, especially post the interest rate capping. Now moving more towards SME, exploring with partners to see how do you score an SME to make sure there's no diversion of funds, which later on contributes to high NPL.
So, Catherine, that's actually quite interesting. And I have a burning question on that particular issue, which can't wait for Nancy. My question to yourself and to bankers is simply this. If, as Alex has said, we have managed to use KYC using technology from what I call a regulatory requirement to a strategic tool, from a personal loan perspective, why can't we do the same for SMEs? What's stopping that transition to actually do the same for SMEs? And in fact, isn't it even a better proposition if we can twist that? Because, you know, there's lots of talk about this micro-lending industry, where people, you know, we've had regulators say that, you know, these are, you know, loan sharks dressed in technology, you know, 40, 50% of this money is going to betting and gambling. So first, just for the for the audience to know that, and this is data not from Ali Hussein, but from industry players like Creditinfo, just to set the record straight. If those micro lenders are called loan sharks, my only comment to that would be 93% of all those loans are coming from these guys here. 93%. 3 players, 4 players who know themselves. They're all regulated. Why are we unable to make that metamorphosis, that change, use the same sort of thinking and the same sort of data available to serve the micro and small medium enterprises? Just as a background, the gap for lending in Africa for micro and small medium enterprises, as per World Bank statistics, is about $86 billion. That's the gap. And I know now, in conjunction with the central bank, there are 5 banks that have launched Stawi. And I think Alex maybe will talk a bit about that on Stawi. So step in the right direction, because Stawi is not personal loans. It's for micro and small enterprises. So what has been the roadblock from actually achieving that for micro and small enterprises?
Good question, Ali. I think for me, I see an opportunity in terms of bankers and other players to apply our minds to say, how about approach SME from an ecosystem perspective? Because SMEs are divided into particular sectors. So for instance, look at distribution, or is it supermarkets, whatever, and say, let me use supermarkets for example. Who are the players in that entire ecosystem? Collect data and figure out a scoring matrix that will speak to perhaps providing funding for the players in that ecosystem, as opposed to just looking at CRB data, or maybe extending it to the directors of the company. There's room for improvement, both from banks and other players.
So you agree there's room for improvement?
Yes.
Okay, great. So we're going to delve a little bit more into that. Nancy, I'm told that data scientists are the hottest thing in town today.
Yeah, that's true.
So Kamau needs to be careful. I'm sort of marketing for you, so we can have an aside later. Nancy, talk to us about what Creditinfo is doing in this space, helping financial services players really get into this scoring for risk-based pricing. Talk to us about some of the data that you are working on a daily basis. Talk to us about your decisioning engine that you could actually help not just the big players, but even the small upcoming players. Over to you, Nancy.
Okay, thank you for this opportunity. I would like to pick up from where Catherine left about SMEs, while the topic is still fresh in people's minds. We had this conversation earlier with Catherine, and I was telling her that...
Sorry to interrupt you, Nancy, but I think we'd really love to hear, maybe in 2 minutes, what your day is like when you walk into Creditinfo. Personally, I'm really keen to learn more about what a data scientist does and stuff like that. Then we can tackle Catherine's.
All right. So my name is Nancy. I look after analytics at Creditinfo. My background is statistics. I have an MSc in applied statistics.
It's already giving me a headache.
So my day-to-day job involves looking at data, trying to draw patterns from it, looking at information that I'm getting from all different data sources and what trends it's telling me, right? So I'll create models from that specific data set, and that's basically my day-to-day job. I create products from the data that I have. What is the data that I hold? What is it telling me? What is it telling me about the market? Yeah? And how do I build a solution for my client who comes to me and they have a specific need? How do I tailor their need to the data that I have? So on a day-to-day basis, it's a nerdy job, but I love it. Data makes sense to me. So yeah, basically that's it about me. If I continue from SME, and this is a conversation I'm always asked, you have a generic score for individuals. Why don't you have one for SMEs and corporates? And my answer is usually very simple. We are in the decisioning industry. We don't have to, we come to your environment and see what your problem statement is and work towards giving you a solution. The thing about SMEs is the information or the data that is used to make a decision about it. A lot of it depends on experts, and bankers here can correct me if I'm wrong, but it's mostly about your experience with your customers, your expert experience about it. You also have information that I don't have. The companies say financial information. That data is not reported to me, so I'm not able, from a generic bureau perspective, I cannot create a scorecard that will predict how an SME is likely to default. What I can do, however, is create a blended scorecard, where I'll come to your environment, I'll pick the data that you hold, your transactional data, your financial information, blend it with the payment information, or rather credit histories that I hold in the bureau for the company, as well as for the directors and the shareholders, because there's usually a correlation between the two. And using all those three different data sets, then I'll create a scorecard that gives you an overview of how the company is going to default if you grant them credit. Yeah, that's from an SME corporate perspective. From an individual's perspective, and I think from where Steve, the presentation that he had before, he talked about scoring and how we have our scores is quite predictive. You could see your A and B's customers had a lower default rate as opposed to your E and the D's and the E's. That's where our decision comes in terms of, especially for the fintechs, the mobile lending. I'll create strategies around the data that you have. I don't only use credit bureau information only. As I said, I'll go to, if a client has different data sources, for example, you're picking data from MNOs. I'm going to create a model where I'll utilize your MNO transaction information coupled with your payment behavior, not only for that specific lender, but for all the other lenders in the industry, and create a model that gives an overall view or a 360-degree view of how this customer is likely to repay this particular credit over a period of time. This is our core business, basically, decisioning and providing solutions, and I like that the industry is moving to risk-based pricing. We've come a long way from bureaus being seen as blacklisting tools to potential partners with different clients, where we are no longer having a bad name. We still have a bad name where you say, I work for the CRB, and you're the guys who denies loans. We don't deny people loans. We help you make better decisions when it comes to giving out credit, because you want to pick out as many good customers as possible and leaving out your potentially high-risk customers.
Nancy, thank you so much. I think that's quite insightful. So before I go back to my boys here, maybe if there is any burning question or comment from my audience, I'm happy to take 2 or 3 comments, questions. Anyone? Yes, sir.
From BSc. First and foremost, thank you for having such a great gathering. So my questions are essentially...
Question, not question.
Question.
I'm taking only one.
Okay.
From an
It's
individual.
essentially more from a patriotic perspective, in reference to the quality of data that is available to us. Like, say if United States is a 10, if you rank it as a 10, where would Kenya rank in in a scale of 1 to 10? And is what we are collecting reliable, like especially that we have a data analyst here, like is the data that is available out there quite carryable to, comparable to, foreign markets? Yeah, I think
that's a very good question.
Stop there.
That's actually a very good question. So, one of you guys would...
Mine is very simple.
Kevin, I have a bone to pick with you. I was not invited to the launch today.
How come? I'll find out what happened. I just want to know from the bankers on the panel, what are the 10 most important risks for, say, a 5-year tenor loan to an SME that's unsecured that you mitigate, and how do you mitigate them?
So to just be clear, the 10 most important risks for, from an SME lending perspective.
Yes, because we're talking about risk-based lending.
Yes.
Right? And
that's a good one, Kevin.
Yeah, so what are the 10 most important risks? And there are 3 banks on the panel, so each must have their own sort of...
Great, fantastic. Great, Kanini? And then I will take I'll ask my panelists to... Yes, Kanini.
Hi, my name is Kanini, a former banker. My question is on SME pricing, loan pricing. I believe that the loan pricing is still based on traditional criteria for, say, character and capacity, which is around either as an individual you have a paycheck or you have financials, and even for the SME. But the truth is, in our country and along many other middle income or hopefully middle income or lower income countries, that income does not come on a regular basis, but somehow in one of the top 100 most expensive cities in the world, people survive. Yet they don't have a salary and they don't have financials, prepared financials or audited books. Yet loans are still priced on that. That discord, how is the banking sector looking to tap into that market that somehow is surviving outside of what the banks deem traditional?
Kanini, you've raised a very, very important issue. Lack of records, SMEs, how can the bankers or the financial services sector actually tap into that? Great. So, my panelists, who wants to go first with the quality of data? Nancy? So maybe Nancy, as you're answering that, maybe it would be a good idea to get a feel of the source of data also, and how that data is synthesized across the value chain.
Okay. So currently, all the CRBs receive data from the regulated entities. This is your banks, the CBK regulated entities, which is the banks, the commercial banks, and microfinance banks. However, there's provision for third-party providers. These are parties that the financial institutions that give out credit but are not necessarily regulated by CBK. So what happens for third-party providers, we as bureaus, we seek approval from CBK on their behalf to list that information. You'll find that we have SACCOs, MFIs, and fintechs reporting that information.
About telcos?
For right now, we don't have telcos reporting that information because of a lot of things. There's politics around it, also the quality of data from the telcos and the utilities. It's not very sanitized, so we're not able to accept it in the database as well.
But Nancy, I'm a bit confused here because Alex just talked to us about how they are getting data from telcos to actually make those decisions. So where is the gap in terms of Nancy and Alex?
So Alex will take data from the telco A. he'll make a decision on it and give Nancy credit. What Alex reports to me is the credit that he gave to Nancy, not necessarily the data he got on Nancy from the telco.
So what you're saying then is that the telco shares data with the bank, but not with an institution like Creditinfo.
Precisely.
Okay, that's interesting. I have a question about privacy, but I'll sort of swallow my question on that particular one and sort of take it offline. Has your question been answered, my brother?
Not yet.
Not yet, okay.
Yeah.
You're still going on, okay.
So for whichever institution is reporting data to us, there's a specific template that's CBK approved that they have to use. So what we do is, once they send us that information, we have to do logical tests on it. The data has to make sense.
How old is this template?
Sorry?
How old is this template? Could you just give us a sort of a feel of the data sets on that template?
Okay, so when the reporting started, the CIS mechanism started, they were only receiving negative information. So banks would only send data that is 90 days plus, 90 days in arrears plus. Then came in the full file listing, where we have the entire portfolio being reported, both negative and full file listing, that being sent to us. So there have been 3 versions of the template, from the very first one that used to do only negative listing. Then we have the one that's doing positive listing, which is version 3. But then again, we have reviewed the version to now, we are now moving into version 4. And version 4 was meant to sort out data discrepancies between the bureaus. So moving into version 4, you won't have different data sets being held by TransUnion versus Creditinfo or Metropole. Version 4 sort of now sorts all the data discrepancies that we used to have. So you will not find your account is updated in TransUnion, but not updated in Creditinfo.
So you've got sort of a centralized point now. That's interesting.
Yeah.
What's the timeline on that?
The new version 4 is supposed to go live in September, and I think
this
the
year?
banks, yes,
That's
the banks have already gotten that information from CBK.
Okay.
Yeah, so it's going to sort out a lot of the discrepancies that the banks raised, which were very valid.
Okay.
And it's going to sort, and we're going even to daily reporting, where
Nice.
for mobile loans, a customer picks and it's reported every single
Immediately.
day. So we have a better view of that customer at the end of the month.
Okay, so on a scale of 1 to 10, to go back to my brother's question, how good is our data?
With version 4, I think it's going to go to a 9.
I'm talking about now.
Currently, it's around 7.5, and I say
7.5?
7.5 because of the small discrepancies between the bureaus.
So when version 4 goes live in September, that goes up to?
Around 9.5. The thing about
Not bad.
data quality, it's a journey. You have to
Yes,
keep
that's-
working, so you don't get
that
to
is-
100% at a go.
That is quite good.
Yeah.
Come on, you have a point?
It's on data. Today, because of that gadget you carry on your phone, we're now moving away from structured data, what Nancy just described, to unstructured data. The amount of data that's generated every single minute, every single second, that is now accessible for decisioning is real. And it doesn't make a difference whether you're in America or in Kenya, as long as you have that device, that data is accessible in one form or the other to be able to make a decision on an individual.
Great. Catherine. So before Catherine sort of takes the mic, the one thing that I wanted to say, maybe to add on to what my brother said there and what Nancy talked about in terms of reporting, you can see in terms of reporting, you can see the culture of how some of these players in the financial services sector actually respond to sort of defaulters. So without mentioning any names, the traditional lenders who've sort of ventured into the mobile lending platforms, the messages you would get would be threatening, almost threatening, literally. We are going to report you to Credit Reference Bureau. You know, we are going to call your wife that you haven't paid this loan, the more, forward thinking, including some of the banks that actually run the fintechs, the more forward thinking you'd get a message like, did you know that if you paid your loan on time, your credit score goes up and your limit goes up? You're seeing that subtle, interesting way, the way things are actually evolving. And I think we are going to see a lot more of that as new players come into the market. Catherine, you wanted to say something?
Yes, as I was listening to Nancy and Steve speaking, I kept wondering how will the landscape change in terms of clean data when more agencies are onboarded to credit reference bureaus. For example, let me use you earlier as an example. If you have a KPLC meter somewhere that you've not paid tokens, what if that data is fed into CRB? What does it mean? What does it say to your, in terms of your character?
So are you talking about the prepaid tokens?
Or if you onboarded more agencies, insurance?
Yes, actually that's an interesting one. That's a very interesting one. Nancy?
For me, I'm a data person, and I think that data is the new oil. As much data as I have, I am able to make decisions about it. However, it has to be clean data. My issue with KPLC, for example, information. Right now, I live in a rental. My bill comes in my landlord's name. Yeah? So if I don't pay that bill, I'm not listed, but the landlord is listed. So you're punishing the landlord for, it's not his fault, but it's someone else. The same thing comes with water bills, right? But if you get to a point where we are able to get clean information, utility information is very important. It speaks more to the character. You'll find the guys here with big loans, but probably do not pay their electric bills. They don't pay the insurance premiums. So it speaks a lot towards, in my opinion.
That's the character bit that we are talking about now.
Exactly, it speaks more to your character than anything else.
That's interesting. Yeah. So you talked about clean data. So I'm supposing that there's dirty data also.
Yes.
So could you just sort of synthesize that for us? What's clean data and what's unclean data?
I'll give you an example. A customer goes to Bank A, they apply for credit, and probably Bank A has someone who sits around, picks that information, fills it in a piece of paper, or even digitally. But they tend to be fat-fingered, and they put that Nancy is 17.
What did you say? Fat-fingered.
Sorry, and instead of putting
it's
Nancy...
called FFS, fat finger syndrome.
Yes. Instead of inputting that Nancy is 27 years old, they put 17 years old. When they report that information to me, I will not pick that information because that information relies to a minor. A 17-year-old is not able to get credit from any bank. So I'll sanitize that information and return it to Bank A and tell them, can you please correct this and tell me the correct date of birth for that specific customer.
Interesting. Thank you, Nancy. Chrispus, back to you. Bit of history, which you sort of opened the door for me. 100 years in the country, Barclays. How many customers did you have before Timiza? And after Timiza, before and after?
So that has actually been a transformative story because in the 100 years that we had the institution in Kenya, we had about 700,000 customers. 700,000 customers. In the conventional bank. But we launched Timiza on 16th of March last year, 2018. And currently we have about 3.5 million customers. And we had 1 million customers in the first 57 days of launching the product.
So how old is Timiza?
March was launched March last year, so around about 1.5 now.
1.5 years, 3.5 million customers, 100 years, 700,000 customers. I mean, okay. wacha nisiseme zaidi, but what I would like, my leading to that question is, how has that transformed the bank? And I was reading a very interesting Google analytics document about how you drove that growth within 1.5 years. Would you like to talk to us a little bit about that and what Barclays is thinking beyond Timiza, if of course you are allowed to give us a hint on that?
Yes, I can probably give just a flavor of an answer to your question, and my response also addresses what Kanini raised in that question. Kanini, you did ask, in this city, most of the players are still using traditional forms of information. So traditional banking is based on things like, do you have a pay slip, do you have a bank account, do you have bank statements, and so on and so forth. And really, the transformation that we've seen with digital banking or mobile lending, to be specific in this case, and I think also Steve did allude to this, is the fact that this gadget that we do, that most of us do carries a lot of information, and we do have a lot of information sitting with the MNOs that would typically not be in the space of what you'd call traditional banking. So prior to November 2012, before M-Shwari came into the market, if I can speak about that, we had a very low banking penetration. But then what the mobile phone has done is that it's become a bank in every customer's hand. And because you're able to do your airtime, you're able to do your bill payments, you're able to do your M-Pesa and so on and so forth, banks are able to tap into the telco environment and really get what I would call non-traditional data. And off the back of that, we're able then to make proxy decisions, whereas previously I needed a pay slip to be able to determine your affordability. Then I'm able to rely on alternative data sets. I'm able to see, okay, if I use you as an example, Ali, I'm able to see how much airtime does Ali buy on a monthly basis. If I aggregate that over a 6-month period and get an average, I sort of get a sense of your LSM, to speak in a marketing term, yeah, of your income profile. Yeah. So for instance,
So for those who may not know what LSM means, that's living standard measures, and that is a very interesting metrics as opposed to the old ABC sort of, how much does Ali earn as opposed to how much does Ali spend. As you know, and on a light note, as you know, that we have a sponsorship culture in this country. So, how much you earn doesn't necessarily equate to how much you spend, if you get my drift.
Yeah,
yes,
thanks for that clarification on LSM, Ali. So I think the point there is, based on non-traditional data sets like your airtime usage, your mobile wallet usage, and so on, we're able to really make inferences that were traditionally not in our scope. And out of that, then I'm able to make an affordability discussion. Now, what interestingly we've done in the case for Timiza is, we've not just relied on telco information for affordability, we've also integrated with the bureaus. We've partnered, for instance, with the Creditinfo, and we're able to augment the affordability decision with what we'd call a risk profiling decision. So from the bureaus, as I mentioned earlier, banks are mandated by regulators to actually submit information, and the bureaus have, over and above just giving a plain vanilla credit report, have innovated and come up with the bureau scores, and we're able to leverage on some of that credit profile to actually be able to make a lending decision. Yeah, and really that has been the bedrock of the Timiza. So to your next question, Ali, if you just give me an extra minute, is how has that transformed the bank? It has transformed the bank because, as I said earlier, we only had 700,000 customers over a history of 100 years. And now with 3.5 million customers, what we've had is a huge amount of information that has then come to our base, and even a different way of looking at our traditional customer, because a good percentage of the 700,000 traditional customers have also come into the Timiza platform, and we're able to actually build better profiles for these customers and to look at them in a different way and to service them in a different way. So it's a very fluid and a very real-time sort of environment where real-time on the phone, you're able to know, look, this customer is probably a business person because I can see every single day at 3 a.m. they're in a particular market, or they are actually they're borrowing for this amount and they're able to pay in the evening. So I'm able to do classification segmentations and able to know, okay, look, these are more of trader-like customers, these are more of salaried guys. Why? Because they take facilities at the end of the month or at the beginning of the month and pay off at the end of the month and so on. So it's given us better insights into our customer base.
Thank you very much, Chrispus. I think let's get back to, before we forget my brother Kevin's question.
In this market and over the region and the world over, we actually do the same thing. We follow the same matrix, we follow the same methodology of lending, but there's something different, because when you look at the SME segment, it's actually the drive of growth for any economy. But I think there's one segment of the market that has not been developed well: venture capitalists. And this I speak about especially when it comes to the IT space. As Kenyans, we all know one thing. I'm sure all of you here will have plots maybe in a weekend to go to Kitengela, Kajiado, to look for land. Because we were taught that land is the only way to grow wealth and invest. But we don't invest in our businesses. And that is a segment that I think needs to grow. Because I think banks have their own traditional ways of running businesses, and they'll continue to be so for a long period of time. But we need to grow more the venture capitalist space, guys who can take risks in a number of entities. Perhaps 20, 19 of them might fail, one might miraculously work out, and then it's able to cover for the losses that have been incurred in the 19. So I think that is a segment that we need to work together and see how do we grow that segment, whereas instead of banking on the traditional banking framework to fund that piece of business.
I think Alex has raised a good point. Let me just add on to what Kanini sort of pointed out, and then I'll give Chrispus an opportunity to respond to Kevin. You know, what is interesting and what is continuously going to happen is very simple. Nature abhors a gap, you know, a vacuum. And unfortunately, when there's a vacuum, something will fill it. Now, what fills it is anybody's guess. It may be clean stuff, it may be dirty stuff, it may be in between, but it will be filled. You can take that to the bank, pun intended. What you're finding in the world today, because of what Alex has said, you have this segment of the economic landscape that is not being filled. SMEs need money to grow. In whatever form, that form may come from trade borrowing. You know, you go to the wholesaler, you borrow for the day or for 48 hours, so on and so forth. But what is happening is that this gap is not being filled. Okay? Now, there's a new sort of bank that is coming into play. And these are the so-called neobanks. Globally today, you've got about 16 to 20 of them. But the is answering your question, Kanini. What it's saying is that most of these SMEs don't have books of accounts, they don't have, you know, so let's enable them. Let's plug in that gap. And as we're plugging in that gap, we are getting a view of what these guys are actually doing from a commercial perspective. And based on that, they are now sort of issuing lending products. Yeah. So, you know, it will be filled. It will be filled. Whether it's going to be filled by a fintech led by a bank or by a standalone neobank, you know, the market will take what it sees on the table. Chrispus, you want to take Kevin's question?
Yes, I think I'll give it an attempt, and probably, if you allow me, before I take Kevin's question, there's also the other question that had been asked around how would rate it. I know Nancy has given a rating. I think in my own opinion, I would say if the person in the audience did make reference to, if we compare it to America, probably I would say if America was, let's say, on a 7, I would say Kenya, we are probably on a 4. And the reason why I would put that is, I'd give it a bit of context to say that when you look at data and scoring, there are sort of 3 constituencies you're looking at. You're looking at the consumer, who you'd also call a retailer, a retail person. You're also looking at SMEs, and you're looking at corporates, and probably even a 4th constituency would be sovereigns or countries. So in as much as from a Kenyan perspective, a lot of strides have been done on the front of consumers or individual customers in terms of the credit bureau, the credit information that is shared with the bureaus. There's still a lot that needs to be done for businesses and also for companies. Most of the SMSs we see in a banking environment still have a long way to go. They're not keeping proper records and so on. So that information doesn't get into the bureaus, and hence doesn't get into credit decisioning. So a lot of progress on the individual side, but still a long way to go, a bit of runway to cover on SMEs and the likes. So that's the reason I would say a 4, in my opinion. Now, moving on to the other question, some of the key, you did ask for 10. I might not give you 10, but I'll give you a pointer. Yeah, so I'll answer your question by asking, what is a credit score? So most of us here have probably seen our bureau reports from Creditinfo or the likes. So a credit score is typically a 3-digit number that gives a snapshot of your credit report at a particular point in time. Yeah. So if you think about that, what goes into forming that score? We look at, or they look at your total indebtedness. How many facilities do you have? Do you have them with one particular lender, or are you spread out across?
Chrispus, sorry to interrupt you, but I'm hoping you're answering that from an SME perspective, not an individual perspective.
Yes, I'll give it the SME spin.
Okay,
yeah?
Great.
So as an SME, they will look at your credit exposure across the market. They will look at, for instance, the facilities you have as an SME. Are you paying them in good time? Are you in arrears? Are you not in arrears? Well, purely from a bureau perspective, that's the sort of information that goes in. But when ourselves seated in the banking space, I think our scope is a bit wider because we do also have transactional information. So from a transactional perspective, we look at how are you conducting your account? Are you honoring your commitments? If you're issuing checks, are they clearing or are they bouncing? If you have standing orders, are they getting funded and so on? So those are all those factors then feed into a credit score. And as I've said, from a banking perspective, a bureau score is just one type of a score. Ourselves in banking, we have we also do have what we call application scores and also behavioral scores. Application scores are the sort of scores we derive right from the information that a customer puts on the application form. So when you fill in, either as an individual or as an SME, once you fill in that application, credit application form, you give us quite a rich set of data. You tell us about yourself, you tell us about your banking history, your length of banking, You tell us about your income ranges, well, for individuals in terms of salary bands, from a business perspective in terms of your turnovers and so on. So using that demographic data, if I can call it that, we're able to actually build an application score and to rank you. And then leveraging or complementing that application score with a bureau score, then you're able to make a more comprehensive decision on a customer. To my point around transactional monitoring or transactional information, that information can also be built into what we call a behavioral score. At this point, it's not at application stage. It's how you conduct your account on a day-to-day basis. That information can be aggregated into yet another type of score called a behavioral score that is able to tell us you're operating at a particular level. So when a bank is making decisions, like for instance, to do limit increases or to offer you an overdraft or to actually offer you an extra product, then that is leveraged off what we call behavioral scores. And I think that ties in then back to the topic of discussion, because it's scoring for risk-based pricing. And those three kinds of scorecards or scoring methodologies, application scores, behavioral scores, bureau scores, form part and parcel of the scoring bit of things. There are other scores out there over and beyond that, that probably now get into the marketing range or things like propensity scores and so on. But all those are some of the factors that we take into account when determining how to support an SME or an individual for that matter. So not exactly 10 factors, but sort of, I hope I've given you a bit of insight into the thinking that goes into it.
Risks. Chrispus, thank you so much on that. So, Alex, Kevin, my brother there, and Kanini, I hope you are satisfied. If not, the drinks will still be flowing after this.
Part of the challenge that I would say we have in the country or in this part of the world, if I could just generalize it to Africa, is that we don't have many data scientists. I think they are the exceptions in the room. And without data scientists, then institutions are not able to deal with any other non-traditional source of data. So to your question, they will lend to the employees because they do understand the payslip game, but then they will not be able to lend to you as the SME because they do not understand, or they're not able to actually figure out a lot of, as in how to use non-traditional data sets. So my first point there is, and it's good we are having this open fire chat conversation, is to call out for more people to actually get into that space, because not only banks, but many other institutions do require people who are able to figure out data and in the form of data scientists and actually be able to add value to institutions. I think that's my point number one. My point number two is in terms of, we had said probably there is another banker in the audience, so I don't know if I stop at first point number one and see whether there's anyone else who wants to take that challenge.
Lending. Now, predominantly, you're a cash-based system, and you lose visibility of the use of cash. Immediately, you hand over cash. And I think that's essentially the problem Ali is facing with his friend. So if you're not putting in the effort to have a system where you have more visibility, essentially what Creditinfo is doing is that they have more visibility of transactions, but you are encouraging, so you're not putting in that much drive for non-cash transactions so that you can have visibility to build, to get better data, to build on better credit scoring. So are you not just, sort of like a dog chasing its tail, where you have an idea of what to do, but your house isn't set up for it? And then to Creditinfo and on data.
I asked for one question.
But I raised my hand like 4 times.
Okay, go on, Michael. 2 questions.
Yeah, so it was mentioned that sort of data is like the new oil, and you're moved on to now unstructured data. At the end of the day, I'm guessing the more you're using more data just to improve your algorithms. And at some point, this data has to dry up, because essentially it's the algorithms which are being trained, and they need more data to train. So immediately they're able to infer better decisions from less data. At that point, do you now stop saying it's no longer about data, but it's now more about the proprietary algorithms you've built that is aiding you? Because for now, it's how many data sets can you connect to more than any other person, and then infer better decisions.
Thank you, Michael. So your first question was to Chrispus. It's okay, I'll give him my speaker so that it can go around. The next question is to Nancy. Chrispus?
Thank you for that question, Michael. I think you're spot on, really. So in this day and age, I think banking has transformed, just like most other industries. And the reason why I said it has transformed, I think a better word to use is transforming. Yeah. So we do have fintechs. Yeah. And fintechs, if I can quote some of the fintechs in the market that are actually doing lending, you'll find that, so for instance, Branch, Tala, the common ones we all know about, you'll find that they're doing exactly what you're saying. They're challenging themselves to really look out at non-traditional data sets and be able to come up with algorithms and find ways and means of supporting customers from a credit perspective. So banks are also getting into that space. Yeah, so right from KCB to Barclays to the other one and the other one, for those of us who are also playing in that field, that's the kind of challenge that we are putting ourselves, we are putting at ourselves to say, banks will be relevant 5 years down the line if you do not challenge yourself or if you do not disrupt yourself, so to speak. So it is a challenge that we are facing. We are all in our different stages in terms of challenging ourselves to get into that space. So as I said earlier, we are saying the new skills that will be relevant in banking and in finance in future would be the likes of data scientists, the like of analysts, the likes of computer programmers and so on, data architects, were able to actually figure out and build such algorithms to address exactly the same challenge that you said. And your question also just leads to Alex's earlier question around unstructured data. Yeah. So, Ali did ask, how then does the industry transform itself? And I think beyond the excellent answers that were given by some of the panelists, I would personally say that there is also an investment that needs to be done by institutions, not only banks, but by institutions generally. Because if you think about it, how banks and other institutions have been storing data has been in relational databases. Relational databases, we all do know, is two-dimensional. It's rows and columns, isn't it? Yeah. But when you talk about unstructured data, you're all of a sudden talking about tweets, you're talking about Facebook posts, you're talking about voice, yeah, you're talking about many other non-traditional forms of data. So even the sort of databases that us as institutions are sitting with, we'll have to change. We'll have to move from traditional relational databases into more 3D enabled infrastructures like Hadoop and so on. And for instance, if I speak about my institution, which is Barclays, if you look at our strategy, even as we are transitioning into the ABSA brand, you'll see that one of our key pillars is digitally led. Yeah. So for instance, Mr. Ali, you'll find that whereas we're still storing our conventional data for our conventional customers, we're storing our data in a relational database, but all our Timiza data is actually seated in a Hadoop environment. So it is a different way of thinking. It calls for innovation. We have a CIO in the panel, so probably she can expound more on what investments institutions need to make. But in a couple of years, the old ways of doing things, even the old investments, the old infrastructures that institutions have been having, will be relevant. You cannot store voice analytics in a relational database. You have to spend money, get in a new system, get in tech people who understand that new system, get in data scientists who are able to figure out how to analyze voice analytics and actually give you commercially exploitable information.
One of the models that we had, our very first models, what we call the SIP score, Creditinfo Predictor Score, was a model that was built on a database prior to 2015, right? 2015 and early 2016. However, there was a major shift in the market in 2016. There was the introduction of the interest cap rate. So there was a significant shift in how people are repaying, how lenders are giving out credit. So we had to tweak our models. The thing about algorithms and models is they're based on the data. They are only as good as the data set that they're built on. So you have to keep monitoring these scorecards. You have to validate them from time to time. And that's what keeps, you make sure that the model or the algorithm that you used at the very beginning is working as it was intended to. Now, right now, the big hula baloo is about the mobile data, right? It's giving us different trends. We are learning a lot of insights from it. We are creating algorithms about it. What happens when we start getting insurance information? What happens when we start getting utility information? We start getting new trends, seeing new trends, and creating newer algorithms as new data sets come in. Algorithms feed on data, so as long as the data keeps coming, then we have to keep tweaking those algorithms. And there are so many new machine learning algorithms, AIs coming in the market. So the two eventually just run hand in hand.
Great. Munyi, I'm coming back to you. I'll come back to you.
Thanks, Ali. My name is Munyi Ndega. So from a data perspective, I think you talked about the individual data on payments not being sort of, you cannot rely on it. The last time I checked, because my previous station we used to do digital payments, the last time I checked, there are 23 million bills out there that you can actually link to a mobile number in this country. So if you use a mobile number as a unique identifier, you're able to grab as much as between 23 to 30 million bills a month, which can actually sort of start enriching your, sort of the data that you're looking at. But more importantly, I want to put this to Catherine and I would ask, when I listen to structured data, I get a feeling that this is data that you're waiting to receive, as opposed to data that you should go and fetch. So if I look at the SME lending space, and I look at the level of digitization within different sectors in this economy. If I look at agriculture, for example, it's a $17 billion sector in this country. Only 4% of it is digitized. It then means that if the lenders do not do anything about the unstructurability of that sector, that 4% will never grow and therefore you'll never be able to access that data. So my question to you, Catherine, is as an institution, from a technology perspective, how much are you willing to invest in terms of solving on the challenges that exist in some of these sectors so that you are able to generate areas where you can actually gather data? I'll give you an example. When in my previous station, when we solved a problem in a Greek in Nigeria, we were able to generate data that allowed a bank to actually lend over $600 million in a year, just by restructuring a value chain. So the question to you is, what is the appetite for the bank, for example, instead of sitting and waiting for reports? What is the appetite to actually go down there and solve for the fragmentation of the value chains so that you're able to get that data and then now you can lend?
So Munyi, I think you've raised some very interesting points.
I would like to ask over the comment or the statement I overheard that there is an 86 billion deficit. It's not deficit, but gap.
$86 billion gap
$86
in
billion
MSME
gap.
funding
Thanks
in
for
Africa.
the correction. $86 billion gap for funding. How is it coming about, according to that statement of World Bank? How is it?
Okay, I will answer that
in
a minute. Yes, the guy behind.
Thank you. My name is Peter Mushemi. I'm the co-founder of Megashift Technologies. I'm a techie by profession and also a businessman. So one of the things I'm so interested in today is you guys are mentioning unstructured and structured data. And I had the opportunity to work with a fintech, therefore I was exposed with banks, the big banks in Kenya. And my interest would be, how is the how is the convergence between all? How are you applying unstructured data with artificial intelligence? Because from a software engineering engineer perspective, is if you develop a model right now, if you develop an algorithm, it will still be the same. That's why you get that the kind of graphs you're getting are giving you the opposite of what you expect, because times are changing.
Okay,
so I would be so
we've
interested.
gotten your question.
So how are you applying machine learning in risk scoring?
Okay, great. So that's, I guess, for Nancy. Back to Muni's question, and that's Catherine.
And I really want to give this gentleman a chance to say something. Okay. 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 I'll tie it back to what I said in my initial comments. Looking to partner with institutions to look at the SME ecosystem.
Okay, so Catherine has basically told you we are looking for capacity beyond the bank. Are we together? And she's ignored my question, which I guess is fine, because I guess we all know what the answer is. So I'm going to answer your question, and then I'm going to give Nancy a chance. So you asked, where is that gap coming from? So basically, this is a World Bank report that said there is an $86 billion gap in funding SMEs in Africa. Globally, it's about 2.1 trillion. The gap comes from the conversations that we've had here, where you have X number of MSMEs, micro, small, medium enterprises across Africa, who are looking for funding, but they can't get it. They can't get it because the tellers and the branches of this world and the banks of this world are giving money to people for, according to some regulators, for what is the term that is being used? For betting. Okay? So that gap is starting to be filled by initiatives like STAWI, okay, which was launched a few weeks ago. Have I answered the question? Great. Nancy?
I'd like to answer about the algorithms that we use, and as well as how we're using unstructured data for decisioning. Now, how scoring works is it uses historical information to make a prediction about the future. So your past is most likely to be like your future if everything else is held constant. How you behaved in 2018 is probably going to be the same as how you're going to behave in 2019 if you don't make any change in your life. Yeah? For that, that's the basic about credit scoring. It needs data. Now, for us, we use logistical regression to make that prediction. So we'll use historical information about your payment behavior to make a prediction on your probability of default over a period of time. We may do 12 months for traditional loans and 3 months for small ticket, small value loans, your mobile loans, anything less than 50,000 shillings and a repayment period of less than 3 months. How we combine that, from the logistic regression model, we get a score. We combine that score with the unstructured data, for example, your M-Pesa transactions. We use that to create a matrix that tells us your affordability and your risk. So the score speaks to your risk, and your M-Pesa transaction speaks to your affordability. From there now, we get to decide how much do you qualify as a client from an affordability perspective and a risk perspective, and give you and allocate a certain limit to you.
What I've not heard from the panel is I think we have moved beyond mobile to APIs. So the future is actually current, what you call open banking. So the banks, KCB, Barclays, you need to open your APIs and work with third parties. You don't have the capacity or capability to be able to do what he's saying. Right now, I work for FinTech, and we have been able to digitize a microfinance with 100 million members in Indonesia. A bank can't do that. So we need to move beyond mobile to APIs, and I think that's where the future is.
That's actually a very interesting comment. My question to you, could you just give it back to him? My question to you is, what is the value proposition? And what is the motivation for these banks to open up their APIs?
It's new revenue streams.
Maybe we need to educate them because the understanding and the idea about open APIs and open banking is that they'll be giving away their customers. Maybe, you know.
So you have data that you don't know what you need to do with it, and you don't have that capacity. So open your APIs and give access to people who know what they can do with it. You're going to charge us for that information anyway. That's the future, I think.
Great. I'm sorry, we have to shut it down unless Fidi gives me permission for him to ask one more question. Okay, I'll take one more question or comment, and then I will come back to my panelists for closing remarks.
Thank you very much. My name is Mukunya. I'm with Oracle, and I'm hearing a lot of data, this, data, that, and access to data. For me, my concern and my biggest concern is data being the new oil. How do we ensure that the data that is sourced and used is used ethically and for the right reasons?
That was a comment, not a question, right? It was a question. Okay, great. Kama wants to take it.
Use the data ethically. I think the best way is to strip the identity of the data. Essentially what Apple does is...
Sorry, Michael, please put your...
Okay, sorry. So to strip the identity of who that data pertains to from that data itself is essentially how you do sort of something blanket in an ethical sense where it's not going to end up being abused, where I can say, you directly have these certain data sets and I can use that maliciously. It's just a certain person who has that data set. It's sort of along the lines of you treat your data as your thoughts. So you have privacy to your thoughts. Not even your government can find that out. So certain data, maybe your religious inclinations and your philosophical ideals, information which the government may need. But surely it's not something you put on any form when you're getting a credit score. So that information sits with the bank, with your government, and your government can push this information to now the lenders, and it doesn't give them the name, and the just tells them is that within this area, 40% are in this category, 30% in this category, many in 30 in this category. So structure your data, as in structure your products that way. Essentially, if you pull out the identity, you preserve a lot of, you take the moral high ground.
Thanks, Michael. Great. I would like to now give my panelists 1 minute closing statements, and then I invite back to the stage our host. Chrispus, over to you.
Thank you. 30 seconds I'll answer Mukunya, and then 30 seconds I'll make my...
I thought Mukunya was already answered
my final. Just to add to what Michael said, we do have GDPR as a new regulation. This is already implemented in Europe. It's coming to Africa. And specifically in Kenya, we do have the data protection bill that is already at the third reading at Parliament. And those are some of the measures that will protect customers. Quickly to my closing remarks. Scoring for risk-based lending. I think my viewpoint is that it is not a new concept. Yeah, if you look at, for instance, even governments. Yeah, when we're going out there for a Eurobond, the rating of the country, whether we are rated a triple B, a triple A, and so on, that is scoring, yeah, and it determines what the country gets in terms of interest rates out there in the international markets. So same case applies to consumers and also to SMEs, and it's really bringing that sort of those concepts into this particular space. Final point is when you talk about risk-based pricing, I find that concept a bit narrow in the sense that I would rather risk-based lending as opposed to pricing, because pricing is just one element among different elements that you can use to risk-base a particular customer. So I could charge you a lower interest if you're a good customer. Alternatively, I could give you a longer term. Alternatively, I might not require you to give me a collateral. Yeah, so I might do unsecured lending. Alternatively, I might say the deposit, if you're coming to buy a car and you're a better customer, I might give you 95% and only require you to do 5% contribution. But if Kamau is a bad customer, then I might say pay 50%, I'm only willing to take. So that just underlines the bit around risk-based pricing to say, yes, it's a very useful concept, but there's a broader way of looking at it under the umbrella of risk-based lending.
Chrispus, thank you very much. I'm glad we've taken the narrow one. I mean, we're at 9:15 now. Can you imagine if we had taken the broader one? We'll probably be sleeping here. But point taken, Chrispus. Alex.
For me, this is a very interesting discussion, and I think as banks we are challenged. We need to go back, re-innovate and rethink in terms of how do you do differential pricing. But I wanted to donate my 30 seconds to Jack to talk about open banking and respond to that gentleman's question.
Don't worry. I was going to get to him. I was going to get to Jack. Don't worry.
I think in addition to what the two gentlemen have said, the future will be quite interesting once more agencies on board to CRB in terms of utility payments data. That's interesting. And then it would be interesting to see if this market, from a regulation perspective, if crowdfunding would work as an alternative to provide funding for SMEs, especially if you look at it from SMEs' contribution to the economy.
That's a good point. Nancy?
For me, I think, in my opinion, there needs to be a culture shift in the market in terms of risk-based pricing. It has been there for a while, but we need to move as banking and lending institutions from the binary checks of listed, not listed. The Bureau has a lot of information that you can leverage to make a better decision. And also in terms of culture shift, I think there's also an employee sort of shift that needs to happen. Most of the times when I go to clients, there's always that feeling that you're giving me an automated number that's gonna tell me whether a person is gonna default or not. Yet I do this for a living. I wake up in the morning, look at applications. If you introduce this automated way, then I'm gonna lose my job. So there needs to be a shift. You're not losing your job, you're making your job a bit more efficient and removing a lot of subjectivity. And that's the market that we want. You want to have a better user experience for your customers. So that shift needs to, there's a shift that needs to happen in the market.
Which is starting, but maybe needs to move faster.
Yes.
Thank you so much, Nancy. I think I want to accept Alex's donation to Jack. Jack, you need to say something because Alex, unfortunately, has, fortunately or unfortunately, has. So Jack, maybe I think just in 1 or 2 minutes, I know it's very short time, but just your experience in building probably one of the most innovative components of any bank in the region.
Yeah, I think, so you have...
So, Jack, maybe a bit of introduction about yourself.
I'm sorry.
You're not as famous as me, so you...
Yeah, so I'm usually the punching bag for that panel right there you see there. My name is Jack Ngari. I'm MD for FinServe Africa, which is part of Equity Group. And, you know, it's a great discussion today, really. I think many times, you know, for some of us who run a fintech within the banking group, we always feel that it's a race for all banks to give loans to the biggest telco customers. So, we all, we don't do mobile lending, we do mobile marketing, because we're marketing to the same base of 21 million customers, using their data, and then trying to weave up a nice user interface to give it to them and give them loans. And you have to respect the fintechs out there, Branch and Tala, and the others, one that was launched today. Because they don't have big telco backing or bank data. So they try to get information from absolutely nowhere and try and score someone and take a risk and keep learning and keep innovating and keep going. Maybe it's time for people like ABSA to buy them and incorporate their technology into their lending platform so they can actually enrich their
Buy them or kill them?
I think probably buy them. Maybe I should buy some. Well, so that's our thinking in many respects. I think I like the comment by the gentleman on the APIs, but it's always a journey for many banks, and they're on the right direction, I think. First you go to mobile, you digitize one service, then you'll digitize your deposits, then you'll realize, oh, okay, we can actually do this on our own and digitize your APIs. So we went through that. When we set up Equitel, we digitized that service, and then now we gave out our APIs. So it's an evolving journey, and I think after APIs, there's something else that will come up. And I think that is the evolution that most banks in Kenya are going through right now. And probably by next year, you'll probably see Sidian Bank already with APIs out for you to use. But it's all looking good, I think. Yeah.
Jack, thank you so much for that. And with that, I really want to appreciate my panelists, appreciate all of you for such a, interesting and vibrant conversation today evening. And maybe a round of applause, and then I will ask. And then I'll hand over to Kamau back. But before that, are we number one? We're almost there. Guys, let's keep at it. I'll ask Kamau to come to the stage. I think there's some appreciation for the panelists. And I hope myself.
Thank you, everyone. I think, and I hope you found the session to be insightful. A lot of things discussed, many ideas thrown, but I think just to summarize, I would probably say everyone has said key things are data and more data. But obviously what is becoming more and more apparent is that we need to move away from the structured thinking and go to unstructured data, go there and get the data, bring it in. And I think for a lot of the institutions, the only way we're going to be able to achieve that is by collaborating with those that are able to go and do it, to build better products that will make your institutions more efficient, cost-effective, and eventually profitable, because that's what the game is all about. So thank you all, and I hope we will be able to see all of you and probably more of you at the next session in about 3 months or so. Please share whatever you think the discussion should be. We'd be very keen to hear what you guys would like to hear about, and we can see who we can put together. Thank you very much. But before then, I would want to appreciate my panel from Creditinfo, Nancy. Oh, sorry, Ali's panel. I just pay. Maybe just stand up and then as you walk down, or should I? Oh. Okay.
Thank you, guys. As these are being given out, please continue tweeting. And I think we still have some drinks at the bar. They need to be finished, isn't it, Kamau? So we need to finish those drinks, right? Great. All right. Thanks, guys. Really appreciate all of you. Thank you very much, and have a good night. Guys, we have to give something for 3 people, and we will be announcing them. Fidi will be coming up here. Where's mine, Bana? I thought you had forgotten me, but Ali's panel. Thank you. Fidi, you want to come up and we announce the 3 Twitterati? You know, if it was LinkedIn, I would be winning this hands down. Maybe we need to do that next time.
Hi, everyone. First of all, I want to thank you so much for coming and for tweeting so much. It was a very hard decision to decide who the top 3 were, but just a second. So there is Lucy Mise. Is she still here? A round of applause for her. She was really... Thank you. We have Kaiga Peter. Is he still here in the building? And we have Pierre Maderi. Is this still here? Oh, yes. So thank you everyone for tweeting and making us trend. See you next time. Have a good night. Enjoy some drinks at the bar.
Thank you all. Thank you.